chance of snow tomorrow. Okay, so the equity method.
Oh,
Okay,
we
right
gotta
here.
start the thing.
We did.
Oh, sorry.
I'm sorry?
It started.
I thought we paused it when you left the room.
She started again.
Okay. All right. So then we have investment in the subsidiary, and then we have investment income, right? So what goes here? Purchase price. And then
End of year
our share of end of year
percentage.
net income. No. What else? Anything else? The undeferred gain, which is last year's gain, right? Okay. What goes here?
Dividend.
Our share of the dividend.
And then amortization.
Amortization, which is not multiplied by the percentage, it comes from the DDES. And then the deferred gain, right? All right. What goes here?
Investment income.
Our share of the end of the year income, net income. And
Amortization.
dividends do not go in there. Do not. They go to cash and here. Debit cash, credit this, amortization. And that is the number one most common. Bless you. It doesn't. Dividends are not part of income. And then we have the undeferred gain and the deferred gain, right? Okay. For our cost or fair value method, your intermediate book calls it one, we call it the other. We either have AFS or trading, and it's a portfolio, and we have dividend income, and then we also have the fair value adjustment, and we have the unrealized gain or loss, right? Okay. These are the two that we're concentrating on, but we also want to remember that we value the portfolio. You with me so far? There's either an adjunct or a contra account. That's this one. This is a contra asset or an adjunct asset. And this is for AFS, it is an OCI. For trading, it is a gain or loss. Gain or loss. So here we put the purchase price, and then we leave it alone. And here we put our share of the dividends, and we leave that alone. No amortization, no DDES. And then if we have a credit there, we have a debit there. If we have a debit there, we have a credit there, right? That's the end of the year adjustment of the portfolio. That's just kind of a review so that we know what we're doing with the investment. That's chapter 1. The other thing review in chapter 1 is the times, right? And so you're going to memorize that formula. Sales, and it's at the sales price, the transfer price. And that's all over the place, right? So we've got that. Then in chapter 2, we did date of acquisition, and all we did was the S entry and the A entry. Because all we had was the consideration transfer, which was the purchase price. And so the S took away the book value, the A took away the excess. Okay. So let's go to the book and do objectives. Actually, no, we won't do that yet. So let's keep going. Several factors then, according to your outline, several factors serve to complicate the process when it occurs subsequent to the date of acquisition. In all combinations within its own internal records, the acquiring company will use a specific method to account for the investment in the acquired company. So they can use that. What they should be using, of course, is the equity method, right? We have more than 50%, and we're going to stick with 100% in chapter 3. We have more than 50%, so we should be using the equity method. But the fact is, we know that we're going to do a consolidation. So if we wanted to, we could just use this easy peasy method, right? And just worry about doing just the dividends is really all we would do. And that would be easy. And so we would just have different procedures to get from there to the consolidation. So the first thing we're gonna do is the equity method, because we're used to that. We're gonna do the equity method. What are the journal entries, the consolidation journal entries? The other reason we have a problem with this, number one, we gotta figure out which method they're using, and there are three. The cost method, or fair value method, or initial value method, whatever that one is, it's this one. Or they're using the equity method, or they're using the partial equity. In the partial equity, the only thing that is different is the amortizations. They're not there. Partial equity looks just like this without the amortization. So far, so good. So I'm going to teach you the consolidation journal entries, the procedures, if we're using the equity method. And then I'll teach you what's different if we use the cost, and then what's different if we use the partial equity. Does that make sense? So we don't have three specific sets. Okay. We're on page 87. And the other thing that is a complication is none of the stuff that we did with the consolidation entries was ever recorded anywhere. It was just on a spreadsheet. It wasn't recorded. So we got to bring everything forward. So it's the snowball. We have to remember what we did. So we have to go back and redo the DDES if it hasn't been done, if we don't still have it. But we're doing the DDES on date of acquisition. We also have to amortize to the date of the financial statement. So it's easiest if we do the DDES and go out to the side. This book takes the strategy of, let's teach them a year, at the end of the first year, when they haven't closed anything yet, and then at the end of the third year. Okay? So we would have closed 2 years and have a current year. And that's important. Even though it's 3 years hence, we still have 2 prior years and a current year. So every time we do one of these problems, we're going to ask ourselves, which method are they using of the three? Cost, equity, partial equity. The second is how many prior years? Not how many years since the date of acquisition, but how many prior years? Because we will have to do our A to the first of the current year. So if there's 2 prior years, we will have amortized each of the things in the DDES 2 years, if it's a 3-year. Okay? All right. So we'll get there. Obviously, we also have earnings. We've got earnings of the subsidiary, revenues, expenses, the cost of goods sold, the expenses. We've got the dividends of the subsidiary. In addition, the parent has an investment earnings account. So in the second column, we have all the subsidiaries' revenue expenses. And pretty much, we're just going to mostly add them across, mush them together after we've adjusted. But the parent, in addition to removing that investment and subsidiary account, we also need to remove the investment earnings account, this one. Because if we kept that in the first column, okay, it's in the first column, if we added that and we added the revenues and expenses of the subsidiary, we'd be adding it twice. We'd have it in the revenues and expenses detailed out, and we'd have it in an investment earnings account. Okay. So we've got to eliminate that. In addition, we have done something with the dividends. We want to eliminate that. We've already recorded the dividends as being a negative part here, but we need to get rid of that and get rid of the dividends on the subsidiary. So in the second column, the dividends paid needs to go against this little piece of the investment account. That's the D entry. So far, so good. Okay. The third note here says, under each of these 3 methods, the balance in the investment account will also vary. So if we were using the cost method, we would never change for these 5 5 things. Okay? The screwy thing about this book is there are a couple of times that the beginning numbers are the same, which means that your consolidated numbers will be different, because I like it better when they give you a different investment number because they've been using the cost method, or they've been using the partial equity method, or they've been using the equity method, because under all 3 situations, the consolidated balances are the same. But every now and then they'll throw a problem in there and they'll say, what if you started with this, but you're using the cost method? Well, then you're going to come out with different numbers for consolidated, because that is different from that. Okay? So I will try to show you when we have that. Let's now do problems 1, 2, 4. So problem 1. It says a company acquires a subsidiary and will prepare consolidated financial statements for external reporting purposes. Why? Because they own more than 50%. For internal reporting purposes, they've decided to apply the initial value method, aka the cost method, aka the fair value method. 3 names for the same method. Okay? Why are they doing that? Because apple, it is easy. All they have to do is, when they get a check with the dividend, debit cash and credit dividend income. That's pretty easy. You don't have to do all these. You don't have to do the percentage of net income. You don't have to do the amortization, the gains. Okay? None of that. It's easy. So why do they use this method? For simplicity. And then the consolidation at the end is different. All right? But that way your non-controller accounting staff can just say, oh, that's debit cash, credit dividends, dividend income. Number 2, a company acquires a subsidiary, will prepare consolidated financial statements for external reporting purposes, and for internal, they have decided to apply the equity method. Why would they do that? And the answer there is B, boy. Because that way the parent can see all through the year what the consolidated balances are going to look like. You see? They get an idea of what the final balances look like. Because they will have, in investment income, they will have what's going to be consolidated, the consolidated balances. It's just, at the end of the year, we're going to take that investment income and go, and split it into revenue, expenses, amortization, etc. Okay? So it's a better internal picture, even though it takes more time. Got it? Number 4, Par Corporation bought 100% of Kimmel on January 1st, 2012, and on that day, Par's equipment has a book value of $420, a fair value of $520. 10-year life. So we're going to, in the DDES, how much will we have for equipment? $100. The difference, the extra. The undervaluation, the overvaluation. It's undervalued, all right? So we're going to have 100, and it's going to have a 10-year life. 100,000 divided by 10 is 10,000 a year. So far, so good. So our amortization is 10,000 a year on that bill. All right? And then it says they use the equity method, and on December 31st, 2014. Okay, so we've answered the 2 questions. Which method are they using internally? Equity. Second question, how many prior years? Two prior years and a current year. 2012 is a prior year, 2013 is a prior year, 2014 is the current year. They have equipment with a book value of $294, fair value of $45, on that day, $444,200. It doesn't matter what their fair value is that day. It doesn't matter what the fair value is that day. It doesn't matter. What we do is we go to the parent's book plus the subsidiary's book on December 31st, 2014, and add the $100,000 from 3 years ago, and subtract the 2 current years, the 2 prior years, and then the current year. So 30. 445-200 and the 357 are irrelevant pieces of information. X amount. What is the consolidated equipment as of December 31st, 2014? It is the book value of the parent, $294, the book value of Kimmel, $190,400, plus the $100,000 from the DDES, minus 3 years, 2 priors and a current, $30,000. So the answer is, for 3 years, 128. Where did they get 128 original? Oh, that doesn't look. 400 minus 272. Did I get that wrong? Oh,
You
sorry. It
skipped
wasn't
that
the
line.
420 and the 520.
So you skipped
It
that
was the
line.
272 and the 400. Sorry. Okay. It's the. Okay. So what was also irrelevant is the 420 and the 520. Sorry about that. What's important is the 272 and the 400. That's 128. Divided by 10 years, 12,800 times 3, 38,400. So make sure you can do this. This is without doing a worksheet. Can you get consolidated equipment? So once again, I'm going to write the formula on the board. It is parents' book value plus subsidiaries' book value plus the DDES amount minus amortization to date. So in this case, the parent's book value was today, on December 31st, 2014, $294, 190.4, 128, which was the difference between the 400 and the 272, right? 400 minus 272 minus, and that would be 3 years times 12.8. That is our consolidated equipment without having to do a worksheet. Some people, very few, but some students I've found over the years like to do formulas instead of or as the first step to the worksheet, or others like to do it in addition to for an accuracy check. However you do it, doesn't matter to me. If you don't even do it, that's fine with me. And this will be the same for all the things in the DDES. Now the goodwill, of course, doesn't amortize. The lands under or overvaluation doesn't amortize, right? But everything else, your equipment, your intangibles that do amortize those things, patents, copyrights, stuff like that, right? Whatever you've got in the DDES that has a year, a number of years. Okay? Still looking here? Anybody need the screen? Okay. So let's go back to the outline. Okay, so what they told us then in the chapter is subsequent to the acquisition date, certain procedures have to be done. And if the parent applies the equity method, the following process is appropriate, and that is SAIDEP, S-A-I-D-E-P, SAIDEP, S-A-I-D-E-P. SAID, the other side of SAID in the equity method is the investment account. And by the time you finish SAID, your investment account should be 0. SAID, the other side, once you've figured out what you're supposed to do, what makes it balance is the investment account. Okay? The EP has nothing to do with the investment account. So, assuming that it's the first year, it says, so that's what we're going to do first. Assuming we're subsequent to acquisition date, but it's only the end of the first year. The parent adjusts its own investment account to reflect the subsidiary's income and dividend. The parent does this. And the good news is, and I'm going to take them out for now, those don't happen until chapter 5. So you're not responsible for the gains. Okay? We've dropped that off. All we've got for right now in chapter 3 is those. So the only time you're doing that deferred gain thing is chapter 1 problems on this final exam. Did you catch that? The deferred gain thing, the times, is just for chapter 1, and that last thing you multiply is the percent ownership because it's below 100 or below 50. Right? Okay. When we get to chapter 5, which you won't do unless you do the masters, but when we get to chapter 5, you don't have to multiply it by the percentage. So it's actually a shorter formula because even though you only own maybe 60%, you control 100%. So we do 100%. Okay, so the worksheet entries, you've got them listed up here, the SAIDEP. So verbiage-wise, here's what they are and what they're attempting to do, right? Now, I'm going to go ahead and erase this so I can put set up on the board, okay? Hopefully you've got those, you've memorized those. Any questions so far? Okay, so let's review S and A. The S is the subsidiary stock. The source is the worksheet. And you're going to debit to the retained, let's do common stock, APIC, and retained earnings. Of the subsidiary, but the retained earnings is not the end of the year. Remember in our new worksheet, we have the income statement, the statement of retained earnings, and the balance sheet. Remember that? This is the one in the middle statement, the statement of retained earnings, beginning of the year retained earnings. Beginning of the year retained earnings. A lot of these things, like amortizing to the beginning of the year, because the current year hasn't been closed. The current year is not closed. So a lot of the things that we're going to eliminate are as of the beginning of the year. Okay? So retained earnings, beginning of year of the subsidiary. And the credit is the investment account on the parents. Right? We did this in chapter 2. The only thing now is it's not date of acquisition, which for the first year is the date of acquisition, the beginning of the year, right, in year 1. So if we're doing a 2014, if we merged on January 1st, 2014, right now we're talking about doing the consolidation on December 31st, 2014. So the beginning of that year is January 1st, 14, which also happens to be acquisition date. So in year 1, this would be the acquisition retained earnings. Okay? Whereas when we get to year 3, it's not. It would be the beginning of the 3rd year, which is the end of the 2nd year. So far, so good. That's your S. Your A entry we also did. And your A entry is your allocations from or of the DDES, and the source is the DDES. And we're going to debit or credit each item in the excess, right? We did this in chapter 2 as well. So if you had an undervaluation of equipment, you had an overvaluation of land, you had an undervaluation of notes payable, you had goodwill. Don't forget your goodwill, right? And the credit is to, again, investment in subsidiary, which is a parent account. These are either subsidiary accounts that you're adjusting, like you're adjusting the equipment, or you're adjusting the land, or they're consolidated accounts. You're creating a patent that's not recorded. You're creating goodwill, so it's a consolidation account. Not a subsidiary, not a parent, but a consolidated. Because some things we adjust, some things we eliminate, and some things we create. And this is a consolidated that we're creating. Goodwill, and the unrecorded intangibles. I know that I'm repeating myself. I don't care. Boring is good. Right? Boring, we got it. I want everybody to do extremely well in this first exam, last exam. Thinking of it as the first. Okay, last. So far so good, right? All right, so let's go to the I. And would you double check and make sure that we can still see me on this?
Yes.
Okay. So the I stands for income of subsidiary. The income of the subsidiary. Now, that's on both columns. The subsidiary's income is, the revenues minus their expenses. It's also in net income, okay? On their middle part, right? Net income, beginning retained earnings plus net income minus dividends equals ending retained earnings. All right, the source is, again, the worksheet. It's the worksheet. So I'm on page 88. And here they tell you, let's go to this, and before I give you the detail of this particular journal entry, we've got let's just go backwards. Page 89 or 88, acquisition made during the year. As a basis for the illustration, Sun Company was bought by parent, and it's 100%. And in this chapter, it's all 100%. It's not until chapter 4, which we're not going over, that we do less than 100. They bought for $800,000 in cash, and they give you the information so you can do a DDES on page 88. On page 89, they give you the DDES. There's your $800,000 at the top. The book value, they computed it by adding up the equity accounts, right? Because book value equals assets minus liabilities equals equity, the sum of the equity accounts. So they summed the equity accounts to get you the book value, right? Okay. And they have an excess determined to be $200,000. Then they went to, compared the columns 2 and 3 on page 88 and did the trademarks that were undervalued by 20, patents undervalued by 130, equipment overvalued by 30, so that was a negative for $80,000. And then I would have taken the bottom exhibit 3.3 and put it beside rather than made another schedule, and I would have put them out to the side. That $20,000 is indefinite, so there's no amortization. We measure from impairment. And you'll be glad to know that nothing in chapter 3 is impaired. Yeah, not until later. Okay? The 130 though has a 10-year life, so that's $13,000 a year, and I would just put that out to the side. $13,000 for 2014, $13,000 for 2015. For 10 years, I've got that $13,000, right? In the 11th year, that drops off. The equipment is only 5 years, so for 2013, it's negative $6,000, and that's for 5 years. And in year 6, that drops off and becomes just the 13. So for the first 5 years, amortization is $7,000. We good with that? Year 6 would be $13,000, and your goodwill is also indefinite. No amortization measured from impairment. So far, so good. And then on top of 90, the parent does the equity method. This is just a review of chapter 1. So in chapter 1, they bought, they got a dividend, then they have their investment income. I erased it. Debit, investment, credit, equity, earnings, whatever it's called, investment earnings, investment income, equity and subsidiary earnings, you're going to see either income or earnings in the name of that account. Whatever it's called, it's got earnings in it. And on the worksheet, it's in the parent's first section, their income statement. Parents have revenues, parents have cost of goods sold, parents have expenses, and parents have investment earnings. Okay. And then they did the amortization. We said it was 7,000 and there it is, which is a flip of that in decreasing each of those same two accounts, right? That's a review of chapter 1 right there. So they're using equity method, all right? At the end of the year, we've got the adjusted trial balances of parent and son. And that's on page 91. The first thing they do is they go through the formula way of how we get all of the consolidated numbers. And I'm going to come back to that after I give you the 6 journal entries, okay? So we're going to do it in 3 ways. We're going to do the consolidated journal entries first. Then we're going to go to just the formulas, and then we'll do a worksheet. And we may or may not get to the worksheet today. So far, so good. We may just look at this worksheet and not do a worksheet today. So hopefully, we still have an hour, so hopefully we'll get through all 3 steps. Because most of the time, they're either asking you to do a worksheet, or to give the entries, or to give the balances. The nice thing is, if you have the worksheet, you can do all 3, right? If you don't have the worksheet already done for you, the setup for you, it's hard, I think. So, but we'll do it all 3 ways because some people like one way better, some people like the other way better. And it is a shortcut too. If you know the formula and all they're asking you for is what is consolidated land, then you don't have to do the whole worksheet, right? So, and some of your multiple choice will be that way. You can see it on your sheet. Computational, consolidated buildings, number 37. Number 38, consolidated equipment. Number 39, consolidated expenses. Number 40, consolidated inventory. So far, so good? So you can see that sometimes those formulas come in, because a lot of times for those, you don't have enough stuff. You don't have the whole worksheet. You can't do it any other way than the formula. Okay. Are we good? Now remembering that that also includes the makeup, that means you have 2 of those instead of 4. Okay. All right, so we've done the S entry, page 92. We've done the A entry, but let's put some numbers in with them, okay, before we go to the I. So for this particular one, the worksheet, so it starts with page 91, and I'm going to go find the subsidiaries, common stock subsidiaries, AFIC subsidiaries, retained earnings beginning of the year. You can either get it from page 91 or you can get it from page 94, which is the worksheet. The worksheet on 94 just has 3 extra columns, but the first 2 are exactly like 91. Read together. They also do credits with brackets. Love it. So we've got when we're doing the worksheet procedures, it doesn't mean that liabilities were a negative 448. It means that they were 448,000, which happens to have a credit balance. Okay. So revenues are not a negative 400,000, they are a credit of 400,000. So far, so good. Okay. So we're going to look for the subsidiaries, and please notice, use the 200 and the 20, which are down in the balance sheet section, but then you use the 380 beginning of the year, beginning of the year. You see that on page 94? You see where the S is? It's 380, not 440. Beginning of the year retained earnings. We're going to worry about all the stuff that hasn't yet been closed to retained earnings in the other entries. The S entry is just getting it back to beginning of the year, which happens to be date of acquisition. So, okay? All right, so there's your S entry, debit 200, debit 20, debit 380. We add them together, and the credit is to the investment, 600,000. That is your journal entry on page 92, and that is on the worksheet, posted to the worksheet. So far, so good.
Now, what did we have to get that 600,000?
The debits, 200 plus 20 plus 380. The investment in SAID, the investment is whatever makes it balance, it's the plug. And you've debited 600,000, so you credit the investment 600,000, which does not entirely eliminate, it just chips away at the investment. Not until you get through with SAID is the investment zero. Hunter, okay? Okay. So then the A, we go back to the source for the A is the DDES, page 89. And we have 4 things that are in the excess. You say, no, I only see 3. No, count goodwill. 4. The 20, the 130, a negative 30, and an 80. We good? We see those 4 things. So we do that because this is the first year. Those are exactly the numbers that we use in the A. Because it is that the beginning of the year is equal to the DDES, the acquisition. 20, 130, 80, negative 30. And then they sum or net to 200,000. Hunter got that? On page 93. You have a 20, a 130, and 80 that are debits, a 30 is a credit, the net of which is 200. Which, remember, on date of acquisition was your excess. So what we've done is we've eliminated, just like we did in chapter 2, we've eliminated, since it's the end of the first year, we've eliminated the book value part and the allocation part. I want to skip over, and we'll come back to this, but I want to skip over to page, it's not there. Yeah, no, that's initial value. I want to skip over to, they don't do, you have to do. Page 97, please. And I want to read to you what happens. I know that we're still in the first year, but I want you to see the difference in the third year, okay? Year 3, consolidation entry A, underneath that worksheet. In the initial consolidation, fair value allocations amounting to 200,000 were entered. We just did that. But these balances have now undergone 3 years of amortization. As computed in Exhibit 3.8, expenses for these prior years totaled 21,000, leaving a balance of 179. Allocation of this amount to the individual accounts is also determined in Exhibit 3.8 and reflected in worksheet entry A. As with entry S, they are calculated as of the beginning of the year, so the current year expenses can be included separately in entry E. So what we're going to do, remember, only 2 of them back on page 91, only 2 of, or 89, only 2 of them had definite lives, right? Exhibit 3.3, 13,000 for the patent, negative 6,000 for the depreciation on the equipment. So far so good, which was $7,000. So look at the A entry, compare please page 97 with 94. Your trademark, the debit is still 20 because it had an indefinite life. The A entry is 20,000 on both pages. Got it? But the patent, 130 on page 94, but then minus 2 years, prior years, 26,000 to get 91, 26, 13,
3 years.
14. Oh, there's 3 prior years and 1 current year, sorry. Okay, 3 prior years. So 13, 13, 13 is 39. So 130 minus 39 is 91. But that doesn't count for that this year. Do you see on page 97 that E, which we haven't even talked about yet, is going to knock off the 4th year? That's the current year. So all we're doing in that 91 is all prior years. 3 prior years and a current year. Are you with me? Is that clear? Okay. So it's not all 4 years, although in the formula we would do all 4 years, right? Because it would be, let's go to page 97, the 540 plus the 420 minus 4 years of 13 equals 1,038,000. The formula will have to include all 3 prior years and the current year. But when we do a worksheet method, we do the 3 in one entry, the A, and we do the 4th year in the E. Okay, we will come back to that, but I wanted you to see that, and that's the clearest way to understand how to do everything to the beginning of the year. So the I then is debit, get rid of the parent's investment income on the parent side, whatever they call it, investment income, investment earnings, equity in subsidiaries earnings. It's got the word income or the word income, and it's in the parents column in the top section. The parents column, top section. And then, so what we're doing is we are reversing out that entry that we made under the equity method at the end of the year. We're undoing it. And it's going against the investment. All 4 of these first 4, the other side is the investment in subsidiary. So in this case, both accounts are on the parent's books. Okay? You say, oh, well then we could record it. No. Why? We just recorded them positive. Now what we're doing is we're going negative, aren't we? We just recorded them in the equity method to get to the adjusted balances. Now we're undoing them. That's only because we're undoing and removing the investment account. We're totally removing the investment account. Our goal in SAID, S-A-I-D, remove the investment account. Okay. And in this one, we're also removing the double counting of the earnings. Got it? Okay. The D takes that other piece, which is the dividends. So it's the dividends of subsidiary. And the source again is the worksheet. The source is the worksheet. So you've seen the S entry, the A entry, the I entry, and you see how it was posted on page 94, the 93. Everybody got that? So we looked at the entry, page 93. We posted it, page 94. You see where it went. We're removing from the parent their earnings and subsidiary. And then we're also chipping away at the investment account, which is an asset. Got it? Okay, the D is a little bit different because we are going to, you remember that dividends are a contra equity account anyway, right? So they have a debit balance. To remove the dividends, because the dividends were paid to the parent. So we don't want to call those dividends because they were paid to the parent. In the consolidation, we're only reporting to the parent's stockholders. They didn't get that dividend. They got the parent's dividend. So we want to eliminate the subsidiary dividends. And we do that, I'm going to skip a line, with a credit to dividends or dividends declared, and that is the subsidiary's dividends. Get rid of them. They were paid to the parent. And this should knock out the investment. The other side of SAID, investment in subsidiary. So the debit here is investment in subsidiary, which is a parent account. So, how do we find out the dividends? We went to the worksheet. We looked in the middle section, the statement of retained earnings, and the subsidiary has 40,000 dividends declared. That's what we're removing. We're removing the 40,000 dividends declared with a credit. So, back to your journal entry, credit that dividends declared, and the other side of all 4 of these first 4 entries is the investment. When they post that, so now you have to the investment account on page 94 of the worksheet, you've got 3 credits and 1 debit. And this is your debit. Okay? And lo and behold, that $853,000 in the parent's adjusted balance column is a debit, plus a $40,000 debit, minus the $600,000 credit, minus the $200,000 credit, minus the $93,000 credit is 0. And if nothing else, that should always be 0. biggest waste of time on one of these tests is that somebody will come out with a number there, and then they'll try to start playing with their journal entries. Better to just erase all four, SAID, and start over again with them, than to say, oh, well, if I add this here and I subtract that there, and they're trying to get to zero. No, they've just done something wrong. They don't know whether it's the S, the A, the I, or the D, but something's done. The most common is that they didn't pick up the beginning of the year retained earnings. They took the end of the year retained earnings. That is the most common error in the SAID. The second most common error is in the A, taking the wrong number to start with of prior years. 13,000 times 3 prior years. Okay? Those are the two most common errors in SAID. So if you don't get a 0, then what you do is you erase everything, okay? And you start over and you double check your S and your A, because those are usually the two. Make sense? And just do them. In fact, go do something else and then come back. Fresh mind. Okay, if you're doing homework, go get a drink of water. Go to the bathroom. Go do a load of laundry. I don't know, whatever. Okay? And then come back and try to look at it fresh. And maybe you'll see something different. Okay, so we've done SAID. The investment is gone. The investment earnings is gone. The subsidiaries' dividends are gone. And all of the undervalued and overvalued things are accounted for, except we have to do the current year's amortization. And that is the E. Expenses of amortization. The expenses of amortization. And that's the 1 year, that's this year. Remember NRT account for the investment earnings and for investment, that amortization's in both of them. We've already recorded them with a debit to earnings and a credit to investment. We're going to reverse that. But we're not going to reverse it. Well, let's look at the journal entry. That's on page 93. And so we've got a debit to amortization expense, because it is a consolidation expense, is it not? Everybody agree? We don't have to go to investment account. It's at 0 now. SAID gone. Okay? So, but what we do want to record, the subsidiary's only been depreciating the equipment and amortizing the patent on the book value. We want the amortization to properly reflect consolidated value. So this is a new expense. So one of the things when you have to do consolidated expenses, yes, it's parents plus subsidiaries, but it's also plus this amortization expense. The $13,000 for the first 5 years, the $7,000 for the next 5 years. So our amortization expense, this is a consolidated account. So we actually debit amortization, and that's a consolidated amortization account, consolidated expense. And then debit or credit the DDES stuff. Okay? Now, you don't have to worry about debiting or crediting the ones that have indefinite lives, goodwill and patent. I'm sorry, not patent, goodwill and, what's the other one? Trademark, okay? The one that has an indefinite life. It's the stuff out to the side. So our source is our DDES. Out to the side, right? The side part of the DDES. The 13 and the 7 equals, the 13 and the 6 equals the 7. Now, what they do is they did depreciation for the equipment, and they did amortization for the patent. And that is most appropriate, but I'm okay if you just, most of the time on the worksheet we have expenses, so it's all going there. What they did on page 94 is they set up 2 lines, an amortization expense line for the patent, and a depreciation expense line for the equipment. Okay, so the 13 went against the 13, and the 6 goes against the 6. Do you see them on the worksheet? Okay. I'm fine if you just debit expenses 7,000, the net of the two. I would be okay with that on your worksheet, because most of the time the worksheet only has one expenses line. It doesn't have an amortization. Actually, most of the time it just has revenues, cost of goods sold, expenses, and then the equity earnings. Okay. So, questions so far? They don't have a P in this one, so we're going to come back to the P. But for right now, and P just stands for intercompany payable receivable. Intercompany payable receivable. So we will come to that later. This is what we need for this particular example. So we've done, what are the journal entries? We've put them on the worksheet. Let's finish the worksheet here. Page 94. 1.5 million plus 400,000 is 1.9 million. That's consolidated revenues. And the good news is that since we're not doing chapter 5, which would affect that because of the intercompany sales, we're not going to have those. But you can see that intercompany sales would affect the revenues. We'd have to knock them out. So for you, consolidated revenues are parent plus subsidiary. That's your formula. Okay? So I'm going backwards to page 90, where they do the formulas. Consolidated revenues are 1.9 million, parent plus subsidiary, okay? So now we're going to flip, hold your place between 90 and 94, okay? So I'm going to finish the worksheet, and each time I'm going to go backwards, and we'll do the formula. You following? You staying with me? I'm just talking you through one, and I think we'll be good, right? Any questions? It's really not hard when you do it one step at a time. Okay. Consolidated cost of goods sold. Again, in chapter 5, we will be affecting that because of intercompany sales. But for your purposes, nope. Cost of goods sold 700 plus 232, cost of goods sold son is 932, and that's what you got on page 90. Parent plus subsidiary. Next line. Amortization expense, 120 plus 32 plus 13 is 165. Right. If it was just expenses, it would be operating expenses of parent plus operating expenses of subsidiary, which they don't even have. Okay, plus the E entry. Plus or minus, but almost always it's more undervaluations than over. It's possible that your E could be on the other side. Okay, in this case it was 13 minus 6 is 7. All right, depreciation expense would be parent plus subsidiary, 80 plus 36, minus 6 is 110 because it was overvalued. So they've over depreciated. We want to knock off some depreciation for consolidated purposes. Got it? 110. Equity and subsidiary earnings should always be 0. That should always be 0. Always, always, always. We knock that out in the I entry. So 0 there and 0 in investment, right? Those two are always 0. And so on page 91, 0. Net income, we add down. It's a double underline. We don't add across. 693 plus 100 does not equal 693. You see? On page 94, we cannot add it across. A double underline, you add down. It's the 1.9 million minus 932 minus 165 minus 110 equals 693. We double underline, we add it down, and we put it below in the middle section, net income, because that one doesn't cross-foot either. Do you see what I'm saying? 693 plus 100 there does not equal 693 either. So you add it down, 693, and put it there. Got it? So net income, consolidated net income for this problem, page 91, 693 added down, which would be, if you're only doing formulas, you start with the revenues and you subtract the next whatevers, and you get consolidated net income, right? You've got your formulas for the others, so you just do it right there. Retained earnings beginning of the year will only be parent because your S entry eliminated subsidiary, right? 840 plus 380 minus 380 is 840. It's only the parent. 840. Dividends declared, or net income, well, you just put it there. Dividends will only be the parent because you eliminated those in the D. 120 plus 40 minus 40 is 120. Got it? Questions? And then you add it down again. It's a double underline. Add it down. 840 plus 693 minus 120 equals 1,413,000. So far, so good. And so that's ending retained earnings. You double underline it and you put it below in the balance sheet. 1,413,000. Got it? The bottom line of one is the part of the next. The bottom line of that is the part of the next. Just like I taught you in, if I taught it to you, in chapter 4 of the principles class, right? Your bottom line in your income statement goes into the statement of retained earnings. The bottom line of statement of retained earnings goes into your balance sheet. Okay, that's all we're doing. Also, because they're using full equity method here, notice that the parent company's net income is $693,000, which is also consolidated net income.
I was gonna ask you.
That's because they're using equity. See, that's why you would use equity, is so that your internal throughout the year, it'd be consolidated.
Consolidated will always equal the parent.
If it's equity method. If it's equity method. Is that cool or what?
Well, it's a good little check. 'cause
It
if
is,
you
if
got-
it's equity method.
If you got through like the setup and then we got there and then that didn't balance, then you'd be.
You know that
you'd
something's
gotta do a load
wrong.
of laundry and do it again.
That's right. That's right. That's exactly right. And your consolidated, and your retained earnings for the parent, 1,413,000, is consolidated retained earnings. If it's equity method, then what we're doing is we're removing those things that are doubled up. Are you getting it? The light bulb's coming on. Isn't this cool? Say, well, why don't they just use equity method so it's easier for us and we can just do setup and be done with it? Well, I'm afraid they don't always do that. They don't always make it easy for us. Okay. Any questions then about end of year one equity method? So we're going to ask ourselves, and I'm sorry that, well, in this case, we ask ourselves two questions. Which method are they using? Equity. And number two, how many prior years? 0 on this page. 0 prior years, just the current. Okay, another thing is you need to be able to figure out which method you're using. And when it's equity method, you will have the 693. So that when you look at the subsidiary, actually, the way you know it's equity is one of two ways. Number one, the investment is no longer $800,000. It's $853,000. You know it's not cost method or fair value or initial value, whatever they're going to call it. Because if it were, that would be $800,000. That's step one for trying to determine which method they're using. The second way is you look at the earnings account and the parent, and you see the 93. I'm on page 94. You see the 93,000. If it was cost method, it would be our share of dividends. The subsidiary paid $40,000 in dividends. That would be 32 or 40,000. It'd be 40,000. 100% of the 40,000. So we know it's not the cost. For two reasons we know it's not cost. You got that? Secondly, if it were partial equity, it would just be $100,000 because they wouldn't be doing the $7,000 of amortization. But what it is the 100,000 minus the 7,000 amortization is 93. Always. There's nothing coincidental about that. That's an always. Got it? So you should be able to figure out which method we're using with just the first two columns done. Also on your test, if you want to come and ask me, write out the word either equity, partial equity, or cost method. write it on a piece of paper and show it to me with a question mark, and I'll either say yes or no. Okay? So you can ask that if you want to. But you need to ask yourself before you ever start anything, which method are we using, how many prior years? Then we do it DDES, and then we can start doing the consolidation entries, and not until. And you're going to show me your DDES. I'm going to nod, and then you're going to start doing your consolidation entries, and I'll check them all.
Should we do those as well before we do the
I
worksheet?
would, because it's easier for me to check them there. But make sure you also put the SAIDE and P on your worksheet, so I can at least look and see where you're wrong. Okay? So far so good. Actually, I would do the entries before I put them on. Okay? Personally, that's what I would do. I would get a nod all the way along the way. All right, that is the end of the first year. Okay, so there's two complexities that we haven't covered. Number one, what's different about the end of the third or fourth year? And it's fourth year. And then number two, what if they're not using the equity method? I think what we'll do today is just go the end of the fourth year. We're still there? Thank you. All right, so what they give you on Exhibit 3.6, I don't really like the format they use, but they give you like the T account stuff for 4 years. I'm gonna erase the board. A little bit anyway. Okay, and I'm gonna show you in T account form what it looks like. Because they would do it chronologically. They did it by character or by function, by each of the 3 years of income and each of the 3 years of dividends and each of the 3 years of amortization. You with me? I would rather see it this way. Purchase price on 1/1/14, I believe it was. And then each year it goes up for income, our share of net income, which is 100%. I'm not going to do the percent because all we're doing is 100% in Chapter 3. Understand that in Chapter 4 we have to multiply it by the percentage of ownership, but you're not going there. So the dividend and the amortization. The dividends in the first year, they tell you what 40, if you read through this, and each year's amortization is 7. So far so good. So that at the end of the first year, remember it was 853, we had that on our worksheet, right? Everybody remember that? At the end of the first year, the worksheet we just finished, it was 853. Okay, then for 2000, that would be at 12/31/14. And then during 2015, we'd go up another 140 now. Your dividends for that year were 50, but 7 for amortization. So far so good. This we did in Chapter 1. What is the investment balance at the end of year 1? What is the investment balance at the end of year 2? What is the investment balance at the end of year 3? So far so good? So we do that and we get, I don't know what, 993 minus 57. 993 minus 57, 946? 936, okay? 936. They don't do it this way on page 96. I kind of wish they had. You following me? All right. In 2016, they did another. They did income for that year was 90, dividends for that year were 20, and they had another 7,000 of amortization. And they will for 5 years. It'll be 777 for 5 years, and then it'll go to 13 in year 6. And so on 1/1/17, our balance is, don't know, 1026 minus 27 is, I believe it's 999. Okay, now we are doing the 12/31/17 balance. So we got to do the 17 entries too. 160, 70, and 7 gives you 12/31/17. 3117 of 1082. And at that point, we're agreeing with them. 1082, I'm sorry that this is probably in your way, I apologize. 1082. So I did it just like they have, but I put it in chronological order instead of the order of, 3 years of income, 3 years of dividends, 3 years of amortization, and then the current year, income, dividends, amortization, which is what they did. Okay? I suggest if you're given this information on a problem, that you redo it this way, so that you can see what you're doing. Make sense? Because we're used to that. We're memorizing that. Up for net income, down for dividends, down for amortization. Up for net income, down for dividends, down for amortization. Each year. And so now we are ready to do the consolidation that year. So we're ready? Who needs a minute? What do you mean, no, you're not ready?
Being hard-headed.
Don't be hard-headed. Couple of you still, well, one of you still running, so I'm waiting.
You're good.
Okay. How about them bucks?
Mm.
I know. You think Lovey's on the bubble? I don't know.
think so. It's only year one, right?
So maybe they'll give him another year? Are you glad Muschamp is gone? Do you
It
care?
was tough to see him go.
I just don't think he was the man for the job in the first place.
Yeah.
He was an offensive coordinator. He wasn't a coach, wasn't a...
So was Jimbo Fisher.
Who?
Jimbo Fisher.
Yeah, but I just don't think Will Muschamp ever changed.
Yeah.
You have to,
He didn't progress.
exactly.
He didn't adapt.
We were
to
concerned
everything.
about that from the beginning.
He had like his ways and he was stuck with his ways. He didn't
Right.
adapt to the situation. that was
Right.
going on.
The head coach has to be able to take, it's just like in accounting. Now Sophia's back in the conversation because she had no idea what we're talking about. Did you know what we're talking about? No, neither did Jessie. Okay.
Oh, she's
Football.
okay.
But anyway,
Maybe it is.
it's like in accounting. If all you do is work for one corporation and you're in management accounting, you're the controller, the assistant controller, or staff accountant, all you got to deal with is one set of books and figure out what. But if you're a CPA in public accounting, you're going into a different company regularly, and they all have different accounts, and they all do things differently, and there is a learned ability to see how each one does it. It's all done the same, but done in different ways. It's like a microwave. Some of them you push this button first, then that button second. And so thankfully I had a gift for being able to go into the corporation, and within an hour I could see that's an asset, that's a revenue, even though they might call it something really weird. I had an ability, and you can, that is a learned ability, but some people learn it more quickly. And that was one of the gifts that I had, which was why instead of staying in, there were some staff people that all they audited was like 2 or 3 corporations every year, the same 2 or 3. So they really were almost like management accountants. All I had to know was those sets of books. They would send me in to do the reviews because I was doing a different one every 2 or 3 weeks. So I was looking at different books all the time. I loved it. I never had any real coworkers. I wasn't ever there to pester people for very long. So nobody got sick of the auditor because I wasn't the auditor, I was the CPA. I loved it. I loved it. And I would use my magic words, please and thank you, and I'm sorry to have to do this to you, and I know you're busy, but could you please? And so by the time I left, they loved the firm. It was lovely. But, I just had a skill set that was a little different than most. Okay, that was your brain breath. Let's get back to accounting. So now we're on page 97, and we've got 3 prior years. So we ask ourselves, which method you see is at the top left-hand corner of that? Equity method. They're still using equity. And it's December 31st, so we ask ourselves, okay, it was January 1st, 14, so we have 14, 15, and 16 Those are our 3 prior years and 1 current year, 17. Yes? 3 priors. Okay, so then they don't write out all of the journal entries. I just erased those, but if you'd like me to, I can write them out for you. Would that be helpful to anybody? Okay, I will do that. So our S entry, I'm not gonna put all the, what it stands for and the source and all that stuff. But our S entry, we're going to debit, common stock, APIC, and retained earnings at the beginning of the year for the subsidiary. So I'm looking, the source is the worksheet. I'm on page 97, and I see 220, and what's the other number?
$600.
600. It's in the retained earnings section. It is not the 690. It's the 600, beginning of the year. Okay? Date alignment, everything to the beginning of the year. I add those up and I get 820, and that's a credit to the investment account. And you can see how they put those on your worksheet. Make sure you understand that that S, that is the most common, is everybody wants to put all 3 of those debits down in that one balance sheet section. And that would be wrong, 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 wrong. So if you've done that and I say beginning, you'll know what I'm saying, right? Beginning. Okay, then you'll know, right? That is going to be your, oh yeah, I remember now. The S, now the A, allocations of the DDES to the beginning of the year, 3 prior years. And so from our DDES, I go back, that's our source, which was page 89. And I go debit to trademarks, which had an indefinite life, so it's still the same number, 20. A debit to patent, it was 130. 130 minus 3 times 13. Okay? 91. Your equipment was overvalued, so that's a credit, right? If we had brackets, it's a credit. And that was 30, but it would be 30 minus 3 times 6. 30 minus 18 is a credit of 12, right? And then goodwill has not been impaired, and that was equipment. Goodwill is the same as it was on the DDES, 80. Don't forget that one. And you know what? Sorry, that's a debit, not a credit. Debit goodwill, 80. Sorry, I'm gonna squeeze it in there, but whatever. 80, and then the other side, investment. So we net those 4 numbers out. And I could cheat and look on page 97, and that's 179. So these were my 4 pieces, 1, 2, 3, 4. And then my investment is the plug. And they put that on page 97. You see how they did that? I'm hoping you're getting bored. I'm hoping this is very boring. So far, so good. Do you have questions? Okay, so we've done the S and A, set it, right? I. Let's do the I. The source of the I is the worksheet. You go to the parent's earnings account, and it's how much? The earnings that the parents have as a result of the subsidiary, how much? I want to make sure you got the right number. Where do you find earnings?
70,000.
Nope. Where'd you get 70? What page are you? No, that's dividends. parent has recorded a debit to investment and a credit to investment earnings. Where would that parent, if they were not consolidating, where would they put that investment earnings? It would go on which statement? Earnings is a revenue account, goes on the income statement. You will find it on the income statement. It is a parent account. Look for it. Equity and
150.
subsidiary
153.
earnings. Get rid of that. Get rid of that. So it's a debit to that account, 153, and the other side is always the investment account, that asset down on the balance sheet. Everybody found it? Everybody understand? That's where you look. You look for the parent's revenue account from the subsidiary. I don't care what they call it. It's almost always the last thing on the income statement for the parent. Okay? Debit that, which makes it go to zero, right? You see on the worksheet on page 97, it made it go to zero. And credit to the investment. We're chipping away at the asset. I said by the time we get to D, it'll be gone. The D, subsidiary dividends, so you look for the subsidiary's dividends. That's subsidiary, that's column 2. How much?
70.
That's your 70. It's a debit there, so you need to credit it. It's a credit to dividends, or dividends declared, and a debit to investment. The other side, SAID, I said, goes to investment. Here's your plug. And at that point, you should be able to cross-foot investment in Sun, 1,082,000 plus 70 minus 820 minus 179 minus 153 is 0. Your investment should be gone. Your E is go back to your DDES, and it's the side part, which is on page 89 bottom, patent, equipment, and goodwill, right? It's the same as it was 3 years ago, and it will be until year 7. Debit amortization expense, credit to patent, credit to depreciation expense, debit to equipment, nothing for the goodwill, nothing for the trademark because they have indefinite lives. Right? And then all we have to do is go across. So once again, they give us, you should be able to do what is consolidated revenues, parent plus subsidiary. What is consolidated cost of goods sold, parent plus subsidiary. What is amortization? Parent plus subsidiary plus anything from the E. What is depreciation? Parent plus subsidiary plus anything from the E. What is equity and subsidiary earnings? Nothing. Always 0. And then you put it down, 953, and you put it there in the middle of the next section, 953. Beginning retained earnings is only the parent now. Net income came from above. Dividends declared is only the parents now. Put it down, 2,577,000, and put it there in the balance sheet, 2,577,000. Okay? Current assets, parent plus subsidiary. Now, there is a P. Let's do the P. The P is the intercompany payable, that's the P, receivable. If the parent and subsidiary are doing business with one another, whether the parent is selling to the subsidiary or whether the subsidiary is selling to the parent, or if one loans money to the other, because the parent can tell the subsidiary, you will loan us money. They control them. Or if subsidiary needs money and parent decides to loan it to the subsidiary, right? Then on one of those adjusted trial balances, we'll have a payable, and on the other we'll have a receivable for exactly the same amount. It does not matter who has the payable and who has the receivable. The journal entry is the same. The consolidation entry is the same. Remove them both. Remove them. Payables have what kind of a balance? Payable is what kind of that, you will debit it. Receivables are assets, they have a debit balance. To remove it, you will credit. This is always credit, receivable, debit, payable. Always. So what they did was sometimes it'll have a separate account. Receivable from subsidiary. Well, there it is. Get rid of it. And sometimes they will have that and not have the payable to parent. But one of them will tell you, or sometimes it's in the verbiage. And it says, I will find it for you. On page 95, that's where you found your P information. So the P information is most of the time in a paragraph. And look with me on page 95. There's a schedule there, and then there's a paragraph that starts for 2017. The last sentence. Furthermore, no, consequently, it's the last sentence. Consequently, parent reports, no, that's not it. Where's my P? I found it. Now I lost it. It's in a paragraph.
Page 98.
Did you find it?
Consolidations.
Last entry, as noted earlier, they've noted it somewhere. So we have to find it. Let's find it. Keep looking. Oh, I see it. Middle of page 95 again. But it's, okay, you see the green consolidation subsequent to year of acquisition. Second paragraph, last sentence. It's usually the last sentence in the verbiage. As an additional factor, assume that Sun now has a $40,000 liability payable to parent. They just told you. And that will be reduced receivables, reduced payables by $40,000. They have to give you the number. They have to tell it to you. And so that's what they did. They credited receivables. They debited payables. They're removing. Okay? So that current assets would be parent plus subsidiary minus the P. And then same thing with liabilities. Parent plus subsidiary minus the P. Are we good? How are we doing? Okay. We are not, any questions? Okay, let's stop there. We'll come back and we'll do the problems for that.